afternoon. This is our last webinar of the year. We will be announcing our 2020 webinar schedule soon. This will include ongoing performance updates and market insights on private placements, alternative mutual funds, non-traded REITs, interval funds, and BDCs. Topics will also include those relevant to current events that impact alternative investment marketplace. We'll publish and email the 2020 schedule shortly, along with links to register, or you could visit AIinsight.com to register for the webinars. We also have a podcast called Alt Insights, which covers the latest alternative investment trends we're seeing. You can find it on our website or social media accounts. You can also subscribe to the podcast on Podbean or Spotify. I'd like to start by introducing Mike Kell, Senior Vice President of Program Management and Business Development. Mike?
Hey, Jen, thank you very much. I appreciate the introduction, the background, and certainly appreciate everyone taking time out of your busy days today to join and listen about why alternatives. A quick shameless plug for the podcast that Jen just mentioned. It's something that we're trying to do more of. We really, our analysts are always behind the scenes, digging through all these different types of investments, see all kinds of great information, and we do these lovely reports to get them out there. And the podcasts are our way to bring the analysts verbally out there and give some audio to what we're seeing, in addition to what you can read in the reports, but really bring more light and clarity to different details. So highly encourage you to check out a couple and see if they're of interest. They're certainly of value, I believe. But really shifting gear kind of to why alternatives. Oftentimes you hear us, a lot of other firms, I mean, really all kinds of topics around alternatives, focused on the different products, structures, strategies, risk, regulatory side of it, all of those great things which are extremely important. But all too often we really struggle, or not, maybe not struggle, but kind of miss the why, right? Why does it make sense to look at these products? Why are they important? What do they can do for a portfolio? How do you use them in a portfolio? So really the why behind alternatives. Certainly these webinars, really, we try to give you a lot of information in a short period of time. So we realize that we can only touch on so much. But having said that, at the end of our webinar, we always have a contact us page. You'll see Lou's contact information at the end. I'm sure everyone on the call has different levels of contacts here at AI Insight, but I can't stress enough that we love to talk to you. We'd love to help educate. We love to provide clarity, and we love to receive feedback. So anything that we can do, whether it's a topic we discussed today or anything we have in the past or something we haven't discussed yet, we'd love to hear from you. So feel free to reach out to us. We just appreciate having those conversations. But with no further ado, I'd like to introduce Lou Johnson. He's a CFA. He's our lead alternative investment analyst, and really what was key in spearheading our recent rollout of our alternative mutual fund functionality, which I think is important because it goes into this topic of really the focus on categorization and what that means, especially when you're looking at it at a portfolio level and considering an allocation. And really, he's absolutely a key analyst here at AI Insight. We're certainly happy to have him do this webinar today. So with that, Lou, it's all yours.
All right, well, thanks, Mike. Yeah, good afternoon, everyone. Thank you very much for taking some time out of your day to join us for the Why Alts webinar. Today, we are going to be talking about retail alternatives in general. So as Mike mentioned, I focus on the liquid side, but we're going to be covering both liquid and illiquid products on the call. Specifically, the agenda is we're going to following a brief intro on kind of why alts is we're going to, one, walk through some of the various structures alternatives that are available through, and then two, discuss different views on building an allocation alternatives within a portfolio, including some important considerations that should be made when doing so that can help in this process. So why alts? Well, there's no doubt that we're seeing a growing degree of uncertainty in markets, coupled with equity prices near all-time highs, interest rates near all-time lows. After a 10-year equity bull market, 30-plus-year bond bull market, the outlook for capital markets are starting to grow lower and lower, and traditional portfolio construction models have certainly become challenged because of this. Alternatives present a viable option to address these concerns, and not to mention the growing complexity that we're seeing in investor needs. So when used correctly, and that is a large challenge with these products, given just the diversity across them, the alts have demonstrated, various benefits, including portfolio enhancement, such as, diversification, that risk reduction you can see, the improved risk-adjusted returns. Alts can assist in, addressing uncertainty by reducing market exposure, i.e. that hedging component. Alts can assist in achieving a specific investment objective or outcome for a client, including, such things as improved yield, alternative alpha, capital preservation, inflation protection, risk reduction, and or some combination of these components, these outcomes. And alts can also assist in just simply managing client behavioral biases and fears, i.e. helping keep them invested in the markets. It goes without saying, though, that alternatives have certainly had some challenges, including the diversity across product. They are difficult to understand, not to mention, build an allocation to due to these complexities. Available resources, they're not well understood or widely available. It has been very costly from a return perspective to not own beta. And alternatives, have certainly had some added complexity around liquidity and fees for investors. Bottom line, though, is we believe the benefits outweigh these concerns and that much of these negatives around alternatives actually can be addressed with proper education and due diligence tools that are available. If sourced properly, alternatives present, a wide array of portfolio solutions. They encompass a diverse set of structures, strategies, and asset classes, and thus can serve in many different ways within a portfolio. So with that said, what we want to do today is cover two broad topics. The first is address the breadth of product structures, kind of an overview of their characteristics and implications, your investment strategies, liquidity, and market timing, among other aspects of allocation. And then we will discuss portfolio allocation considerations, including, providing various ways to organize alternatives and important considerations that should be made in building an allocation. First, so jumping into structures, first I'm going to begin with the obvious, kind of cruise through this one. I think this is a popular one. And that is the mutual and hedge fund structures. These excel really at offering that access to alternative strategies, your long-short equity, managed futures, your multi-strategy, among others. Both structures also offer access to alternative asset classes such as real estate and commodities, and alternative trading strategies such as leveraged and inverse investing. Hedge funds also offer some additional access to less liquid strategies that really don't translate over well to a mutual fund structure, such as your distressed debt and private equity, among others. So a primary benefit to these structures within a portfolio is the access really to actively manage diversified pool of investments, which really can help reduce risk. But very importantly, it also removes much of the market timing risk from the investor, meaning really these are designed to be held as part of a strategic allocation in a portfolio in general. The trading strategy is excluded. The two structures became very popular following 2008, given the recession. And understanding the difference is very important, as there's a significant crossover in asset management between these two structures, meaning there are a lot of asset managers out there that offer their strategies through both structures. Specifically, the limitations imposed by the 40 Act structure around these investable securities, liquidity, leverage, they'll lead to different risk return profiles between the two structures that are important to understand. Specifically, so by having less limitations, a hedge fund really has a wider opportunity set for seeking returns, and their asset base is generally more sticky given that limited liquidity provisions. A manager's skill, however, is not changed by what structure they offer their strategy within, and the additional opportunity set afforded by the hedge fund structure will typically lead to a proportional increase in risk. So the bottom line, these structures are popular for providing that diversified exposure to alternative investment strategies, but it should be expected that a mutual fund counterpart will generally provide less return and less risk given the 40 Act guidelines, but you pick up that benefit of daily liquidity. That said, investors should expect similar risk-adjusted returns across the two structures. Another pooled investment vehicle that's really growing in popularity is the interval fund structure. Now, these are a subset of your closed-end funds, and the structure is popular in providing investors access to less liquid asset classes such as real estate, and then high yield and non-rated credit. There are also a couple sizable funds out there that offer some exposure to insurance-linked securities and some alternative equity-like strategies. And this ability is really due to an important distinction between closed-end fund and an open-end mutual fund structure. And I'll touch on that here in just a second. End funds, including the interval, are regulated per the 1940 Act with similar fee and management structures in the mutual fund. However, how the two are offered, though, is quite different and important to understand. And so along these lines, with the traditional closed-end fund, a fund's going to raise capital through an IPO, then list on a public exchange. The number of available shares is thus fixed, and it is traded with liquidity really driven by the breadth of the market. Now, the interval fund, on the other hand, is a type of closed-end fund that is non-listed. It is structured as a continuous offering, just like a mutual fund, but unlike the mutual fund, that structure only offers investor limited liquidity on a periodic basis. And this important difference is what allows the structure to be more flexible in what it invests in. Specifically, the structure does not have that 15% cap on liquid securities unless is able to go out and seek alternative return sources through less liquid asset classes and less liquid securities just in general by not having that daily liquidity responsibility, if you will, to investors. It's also important to note that a closed-end fund, it can't be structured as a non-listed security. This is a non-traded closed-end fund, and it is very similar to the interval fund, but with one important difference. The interval fund is required to provide X amount of liquidity per year, while the non-traded closed-end fund is not. It's at the fund's discretion. All right, so another important structure to touch on is the private placement. These are non-public offerings primarily used to raise capital from non-institutional private capital. They are exempt from the full SEC registration, which makes them an ideal vehicle for emerging asset managers. However, they are often used too as a seeding vehicle for new strategies launched by some larger asset management firms as well. Now, how they are structured depends on how the offering is organized, which is primarily governed by Regulation D from the SEC, which is where that phrase Reg D offering comes from. It includes 6 rules, with rules 504 through 506 governing that offering structure, which we have summarized here in the table graphic. Important considerations. Well, the private placement is a smaller offering, much smaller compared to a pooled fund, meaning it's going to be less diversified. Generally illiquid, primarily focused on a single asset class or sector. Now, this presents material risk to investors as the offerings are subject to significant losses if they fail. The offerings also have some market timing components involved, and there is sort of a very limited consistency across offerings, requiring a significant amount of due diligence to understand the investment. So you might ask, well, what is the benefit? Well, this limited registration requirements allow offerings to be quite nimble and very opportunistic, launching for market opportunities as they develop. And it also allows asset managers to invest in more niche areas of capital markets. Both of these present the opportunity to bring alternative sources of return not traditionally available to the retail investor. We've listed some common offering examples here on the bottom. Lastly, let's just quickly address the Real Estate Investment Trust, or the REIT. This is an investment structure that pertains specifically to real estate investments, including debt and equity. They're a pooled portfolio offered as a security, but the company itself might be organized as private, i.e. non-registered, publicly registered but non-traded, or publicly registered and traded. Private REITs, as their name suggests, these are not up to the public. They are available only to accredited investors. The publicly traded REITs, commonly considered kind of quasi-equity substitutes, given their high positive correlation to public equities. Thus, let's kind of just focus on the non-traded REIT. And what is important to note with this structure in particular is the growth in the perpetual offering as opposed to a traditional life cycle REIT. Now, the latter typically focuses on a single real estate sector. They raise capital during a finite period, invest said capital, ultimately look to return that capital at a premium to investors, similar to how a private equity fund operates. Perpetual REITs, on the other hand, these offerings raise capital and manage a portfolio of real estate investments just the same. However, the length of the offering is indefinite, and the portfolio will generally be diversified across sectors. Now, this can create a completely different return profile, as capital appreciation is less of a focus as income. It's not to say it's not a component, but it's less of a story as it is an income story. And, these portfolios tend to be more stable, investing in high-quality properties, providing investors with that stable dividend, limited liquidity on a periodic basis. To a degree, this also helps reduce some of the market timing aspect of investing in real estate, whereas a life cycle REIT is more susceptible to the entry and exit points associated with that type of offering. Bottom line, depending on how a REIT is structured, can have significant influences on the real estate exposure you receive within your investment. So this is always important items to consider here. Now, when considering the various investment structures we talked about in general, the two important items to consider when building an allocation is liquidity and market timing risk. Now, liquidity varies widely across product, from continuous to limited to no liquidity. And this is very important in considering an allocation, as shorter investment horizons from a client can really create significant liquidity risks for investors in these types of offerings. And along those lines, market timing risk. Depending on how a strategy is structured and what it invests in, there can be some significant market timing risks associated with how that investment earns a return. Furthermore, it is important to understand investor requirements, as various structures are for accredited investors only, or both in the case of private placements. There are some exceptions here. All right, so now that we've covered some available product structures and some of the implications they have, let's address the question of portfolio allocation in regard to alternative investments. Very difficult question to ask, which is why many advisors steer away from alts altogether. In fact, according to a survey conducted by Blackstone with Investment News, 67% of financial advisors cited lack of client understanding as a key hindrance to them using alternative investments. Furthermore, 51% of advisors cited needing more insight into portfolio construction with alternatives as a headwind for incorporating into their practice. Other headwinds included client education, operational issues, paperwork, etc., and then just general education around even defining what alts are. These headwinds become evident when you look at allocation statistics here, which we're showing. On the left is a graph summarizing allocation by advisor AUM. This information was sourced again from that Blackstone study. Utilization, it does increase, as you can see here, as you move into larger advisor AUM tiers. However, the portfolio allocation weights themselves remain sub 10% across all three AUM tiers. This compares to an allocation average of 30+% among institutions as compared by the graph on the right. This is sourced from Willis Towers Watson's annual Global Pension Asset Study. Now, this is not to say that retail weights should be this high or is equal to institutions, but it does demonstrate the role that education and available resources to play in applying alternatives in a portfolio. It may also support some explanations around AUM, as the two appear to be exhibiting positive correlation. Larger AUM bases lead to large alternative allocations. And what we will do today, though, is kind of give you some examples of how to help think about this. Important considerations that need to be made, and what an allocation is really designed to do from a performance perspective, and what you should watch for when evaluating alts. So hopefully this will prove informative in demonstrating, why alternatives can be a useful tool and how to better approach, the due diligence around these products. All right, so how to think about alts when it comes to portfolio allocation. So we're going to run through a couple of third-party studies, and then we're going to highlight how we here at AI Insight on our mutual fund platform think about it as well. So the first here is a piece put together by Natixis and their investment strategies group, or ISG. Now, ISG, within their firm, they specialize in performing asset class and investment process research. Really, it is their job to think about investments from a portfolio perspective. So in this piece titled Divergent Strategies, a new way to think about portfolio construction, they identify investments through a lens as either being convergent or divergent as a way to assist portfolio allocations. Now, the core of the research focuses on rational markets versus irrational markets, and that in general, the markets are in one state or the other, or in some sort of flux between the two. In a rational market, the definition being market participants exploit short-term mispricing to bring asset prices back to fair value, i.e., asset prices are in a period where they're responding to fundamentals. Now, this is where your convergent strategies come into play. They are designed around this premise that markets are rational and that an active manager can go out and leverage their fundamental research processes to make profitable investment decisions, both long and short. Now, in contrast, the irrational markets are characterized by periods where fundamentals are ignored and volatility dominates asset price movements. These periods are often characterized by contagion, by increased correlation across asset classes. They might include asset price bubbles and busts. Bottom line, some underlying influences are dominating asset prices outside of fundamentals. Now, per the study, this is where your divergent strategies will come into play. And these strategies invest based on signals outside of fundamentals, such as, say, volatility or price momentum. And they're often systematic in nature, with the prime kind of tiered example of this being a managed futures fund. Bottom line, the strategies are expected to perform during irrational periods. Now, Natixis takes this and they apply this concept to asset classes and strategies as a way to think about portfolio construction, and more specifically, as it relates to remaining diversified across market regimes. The conclusion being that adding divergent strategies is important to remain diversified during negative market periods, whereas the success of convergent strategies, on the other hand, is in part actually aligned with success of traditional investments, given the reliance on these various market mechanisms tied to fundamentals, and thus they provide less diversification benefits. Key takeaway being here that not all alternatives are created equal. As seen by the graphic, convergent and divergent strategies include both traditional and alternative investments. And this is why this study was selected for this webinar, because it identifies a couple of key considerations for building an allocation to alternative investments, and that's one, understanding performance expectations relative to market conditions, and two, that not alternatives are created equal when it comes to diversification. Understanding these principles will certainly help in understanding how a strategy fits within a portfolio, and it will also help provide reasonable expectations for benchmarking the investment on a going forward basis as well. All right, so let's move on to a framework provided by Morgan Stanley's Global Investment Committee. In a piece titled An Outcomes-Oriented Approach to Alternatives, Morgan Stanley, they provide a framework for alternative investing that is based on aligning client objectives with the investment risk return orientation. Now, the premise here is based on correcting this false perception that alternatives are a homogeneous asset class, but instead really are a collection of diverse, non-traditional strategies and asset classes that can serve different purposes in portfolio construction, and I should say that do serve different purposes in portfolio construction. And to address this diversity, they use analysis to sort of organize alternative strategies into 5 goal-centric buckets, which you can see here on the table on the far left. The framework provides some helpful connections for thinking about alternatives. As summarized by the graphic, it organizes, like I said, the client goals into 5 categories, but then translates them into an investment objective that can be targeted using alts, and then provides examples of alternative strategies and asset classes that sort of fit within each. This type of approach, it can be helpful for multiple reasons. It can help narrow the list of alternatives considered for investing, if a general investment goal is understood or known from the client. Another benefit is the approach helps manage performance expectations for alternatives, which can provide insight into how much to allocate to a particular investment or from where to even source the allocation from, albeit equities or bonds. And Morgan Stanley also believes the approach can assist in developing benchmarks to monitor performance on an ongoing basis. These are provided on the far right side of the graphic here. We're going to touch on this aspect of benchmarking here in a little bit. Now, the bottom line is this study was chosen because it also helps identify a key consideration that should be made when considering alternatives, and that is understanding what the strategy or asset class is designed to do. This means understanding how the investment is designed to earn returns in the market and the risk associated with achieving said returns. Now, for example, like in a managed futures fund, returns are dependent on sustained price trends, either negative or positive. If markets are exhibiting choppy up and down behavior with limited directionality, strategy will generally perform poorly. So sort of understanding these aspects is key. Now, another important consideration in investing in alts is understanding that downside risk of the investment, i.e. what is the market exposure of the underlying strategy or asset class. And this is an extension of the prior two considerations we just discussed. And at AI Insight, we do this by categorizing alternative mutual funds into one of four buckets based on their downside beta to both traditional equity and traditional fixed income. The graphic here summarizes how we bucket strategies according to this metric, and it kind of shows if a fund has lower downside beta to both stocks and bonds, it's exhibiting characteristics of a core alternative product, providing downside protection to both asset classes. Now, if downside beta is higher for both, it's exhibiting characteristics of alternative beta, meaning historically has not provided downside protection, but really just served as a diversified source of market returns. Now, this framework can be applied to other alternative structures as well. Furthermore, this has been simplified, so other metrics, should and can be considered in this type of analysis, including correlation, capture ratios, and max drawdown, among others. Now, understanding the downside risk and volatility relative to traditional asset classes can be highly informative in building an allocation, especially if you have that portfolio objective in mind from the client. All right, so let's bring this all together, and what are some important things to watch for with alts? Well, in regard to market performance and risk return expectations, it is important to kind of understand whether an investment manager is strategic or tactical in their investment decisions, because if they're more tactical, this can lead to large differences in portfolio compositions over time. This can also be the result of changes in portfolio management personnel or just changes simply to the investment process itself. Bottom line, these are red flags if you are looking for consistent expectations over time, which is key in building portfolio allocation, things to watch for. In regard to the downside risk we were talking about, be sure to review performance statistics from both an up and downside performance perspective, because this can be more enlightening about the true diversification benefits of the product. Bottom line, some alternatives may exhibit diversification, less diversification when you want it to, and more diversification when you don't want it to. So thoughts to risks to consider there, and these kind of metrics will help you do that. i.e. looking at like upside correlation, downside correlation, upside capture, downside capture, etc. Volatility. What is the risk profile of the investment? What to watch for here? Is the volatility volatile? Meaning, does the risk profile change over time, or does the manager have a risk target they're managing to? Risk with respect to return horizon. Many alternatives invest according to a full market cycle, meaning performance and risk may look poor over short periods of time. And understanding what your loss tolerance, your risk tolerance is important, because this may simply just be par for the course. Selling out during a rough patch may exacerbate investor losses and kind of compound the issue of diversification here. Liquidity. What is the available liquidity of the investment? What to watch for here? Is liquidity required by the investment structure, or is it at the manager's discretion? With the latter, be prepared to have investor capital locked up for periods at a time. And with limited liquidity, if an investment offers this, it does not mean, it's important to understand this does not mean you will be able to access all of your capital at any given time. This is evident in market pullbacks where multiple investors may be looking to redeem capital. In this instance, you may only be able to liquidate a portion of your investment. Furthermore, what is the risk profile of the investment relative to liquidity provisions? As an example, in 2015, we saw the Third Avenue Focused Credit Fund get shut down, following a wave of investor losses and redemptions. This was arguably caused by a mismatch in less liquid, higher risk securities within a daily liquid vehicle, which created a cascade effect of losses leading to redemptions, led to more losses, and so on. All right, and to conclude, I want to talk about another important consideration of alternative investments, and that is benchmarking. Incredibly difficult given the lack of homogeneity across investment structures and strategies. Popular mechanisms for this include cash plus, the 60-40 portfolio, and peer grouping. But each of these have some challenges, and we've listed that. We've listed that here in our graphic. And so instead, we want to encourage analyzing investment performance from a portfolio perspective. One way to do this is by modeling portfolio performance with alts. It can be used to assess changes kind of to the downside risk or risk-adjusted performance. This graphic here was pulled from the Texas study we discussed earlier, and it also presents some interesting metrics to consider, some other interesting metrics to consider, one being skewness, which is another way of saying, hey, what is your tail risk with this portfolio? Bottom line, alternatives in general should reduce portfolio risk, thus assessing portfolio performance for an entire portfolio for these risk-oriented metrics relative to, say, a traditional asset allocation portfolio can be a very useful tool, a more productive tool in benchmarking whether these products are additive. Here we have the graphic was pulled from the Morgan Stanley study we discussed. It suggests comparing risk-adjusted performance across investments and portfolios. This also can help determine whether an investment is additive to a portfolio. Morgan Stanley also looks to demonstrate the spectrum of offerings and group them by their risk-adjusted return attributes, and can be seen here by the risk reduction versus return enhancement strategies and asset classes on the right, an extension of that client-centric goal grouping of alternatives. All right, so with that, I will kind of finish my comments, and I hope today's webinar was helpful in presenting the diversity that alternatives present as portfolio solutions. I hope this webinar was also helpful in creating new pathways and processes for thinking about portfolio construction and the different ways alternatives can be additive to a portfolio. Furthermore, I hope the webinar was helpful in discovering kind of important risk considerations and due diligence items when considering alternatives, which in turn should be useful in assessing whether alternatives make sense and how much to invest and where to pull from. So with that, I will kind of end my formal presentation and turn things back over to Jen to wrap things up.
Well, thank you, Lou. That was very informative. I also want to thank the audience for joining today. Please remember that was a lot of information in a short period of time. So please, we are happy to help understand at any level. So please reach out to us to discuss further. We can be reached. Lou has his information here. Also in the bottom right hand corner, you'll see our 877-794-9448 number. Extension 710 is our customer care, and they would be happy to direct you to a person to speak with as well. I hope everyone has a great evening and a happy Thanksgiving. Thank you.